had a stellar run this year. This week it has crossed $2,000 a troy ounce, and a 36% plus return this year makes gold the best investment asset in 2020. Even with prices at these lofty nominal levels, few are calling for a drop in the price of gold and prompting some to warn of a bubble and stunning even veterans of this industry. Much of the rally in the price of gold stems from efforts by central banks to shield the global economy from the worst effects of the coronavirus pandemic. Interest rates in large economies, which had started to pick up after the last financial crisis in 2008, have headed back close to zero, some even negative interest rates. That, plus the central bank's aggressive bond buying programs, have crushed the returns available to buy and hold investors in government debt and left little room for price appreciation. Meanwhile, inflation expectations, while low by historical standards, have ticked much higher. That leaves gold typically second best to bonds, as it does not provide interest payments. There's no coupon payment, in a rather sweet spot. Its upper limit is confined only by what the next buyer is prepared to pay. Gold has become an increasingly important part of portfolios in a low yield world. Across the world, you find fund managers, you find financial advisors, investment advisors say you should have at least 5 to 10% of your investment in gold. Do I agree? No, not really. Some of the most prominent hedge fund managers have in many cases reluctantly turned into gold bulls. In a letter to investors in the month of May 2020, Paul Tudor said that a simple ratio tracking the value of gold above the ground to global money supply suggested that a price could reach $2,400 a troy ounce, even go beyond. If demand becomes as extreme as it did 4 decades ago, before the then Federal Reserve Chairman Paul Volcker ratcheted up interest rates to tame inflation, prices could reach even $6,000 according to Paul Tudor. Well, I don't agree with this at all, but gold remains a very attractive hedge against the great monetary inflation and hedges against other risks clouding the outlook, including a renewed flare-up in US-China trade relationships. And as the US presidential elections come closer, you will find a further flare-up in US-China tensions, and this could lead to an even further rise in the price of gold. Jewelry demand is not a factor here. Demand for wearable gold has collapsed in major markets such as India since the coronavirus struck. Instead, much of the support comes from exchange-traded funds tracking the price of gold. One such ETF, the SPDR Gold Shares, has this year snapped up physical gold to match the investors' demand at a record-breaking pace. The size of the fund's holdings, which are held in HSBC's London vaults, has climbed to more than 1,200 tons, making it a bigger gold holder than the central banks of either Japan or India, or China for that matter. Don't forget China. Gold bulls say that a metal is still under-owned by historical standards. Bank of America says that gold investors now keep about 5% of that. Globally, investors now keep around 5% of the assets in gold, as I just mentioned a little while back. Half the size of allocations in 1980. Now, Jim Luke, who is a fund manager at Schroders, says that gold-backed ETFs represents about 2.5% of the global ETF holdings, compared with 10% in 2011. So what happened after 2011, friends? Well, we should all be concerned about a repeat of gold's previous sharp rallies in the late 1970s and in 2011, after which prices collapsed 55% and 33% in the following 5 years. I repeat this sentence, and you must hear it very carefully. We should be concerned of the repeat of the gold's previous sharp rallies in the late 1970s and in 2011, after which prices collapsed 55% and 35% in the following 5 years. So does it make sense to invest in gold 5% to 10% of the holding? Well, I think we should be careful. 2020 will see some more rise in the price of gold. Currently around $2,050 a troy ounce. I would not be surprised to see gold even headed towards $2,200 a troy ounce very shortly in the next few months. And in India, the price currently of gold is 57,500 a gram. And again, I would not be surprised to see here a rally towards 62,500, even 63,000 a gram in the near future, very near future. However, once this year is out and we step into 2021, I think the stage is being set for a correction in the price of gold, especially middle of next year. I believe that we'll see a sharp correction in the price of gold prices, so be extremely careful. I do not think that this is a great medium-term investment, but if you were to ask me whether this is a good investment for the short term, for a few months time span, yes, it has a lot more steam left. But beyond that, yes, a correction is overdue once 2020 is done with and rusted. So be careful. This is the time where there's a lot of uncertainty and gold is doing well, but need not necessarily carry forward into 2021 and beyond. So those fund managers and financial advisors who are talking of a relentless rise and a rally in the price of gold, I think are talking of something which I do not think is going to happen. And there is an over exuberance in the price of gold. But yes, short term, there will be more tensions and and a further increase in the price of gold is definitely on the cards. You can easily see another 10 to 15% rise in the price of gold from here. Happy investing and enjoy the gold rally. And if you have bought some gold ETFs, then I would not say that 5 to 10% should be a part of your portfolio throughout. But yes, in the meanwhile, enjoy the rally, enjoy the golden ride. Happy investing. Take care. Bye-bye.